Fewer meetings and greater transparency, changes at the RBA, what it means for borrowers, and we preview tonight's US inflation figures. That's next. It is your daily 10-minute business and finance news wrap for this Wednesday, the 12th of July, 2023. Later on Market Day, we will speak with Francesco De Stradis from Ord Minnett about the day on the markets. But first, to the Reserve Bank, which has responded to the government's review and will make some changes to the way it operates. The big change is the frequency of board meetings. So instead of 11 times a year from 2024, the board will meet 8 times a year. Those meetings will go over 2 days as opposed to 1, which is now the case, and a media conference will now be held after the announcement. That announcement will continue to be accompanied by a written statement, but issued by the board instead of the governor. And there will also be a pre-meeting so that the board can consult with other internal staff to hear from a broader range of opinions. It has, however, avoided other decisions, which it says avoids the current board locking in the new board into a particular approach. So that includes the publication of an unattributed vote count and that all board members make regular public appearances to discuss their thinking and decision on monetary policy. So for his take on all of this, I spoke with Shane Oliver, the Chief Economist at AMP Capital. Shane, so the RBA Governor has announced some key changes from 2024 in terms of the way the board meets. First of all, less frequent meetings, 8 a year instead of 11. Why do you think that is?
Well, it's basically consistent with the recommendation from the review. And the theory is that if you're having a meeting every month, like is currently the case, it doesn't give you a lot of time to assess things. Obviously, many of the staff at the RBA are just responding to recent data and summarising that data. Whereas if you spread those meetings out, you could have a more considered process and a better analysis. So the aim of it is to increase the quality of RBA decisions.
What will it mean for borrowers, though? Could it mean bigger moves in interest rates than what we're used to? Normally 25 basis points. And is that a good or a bad thing?
On balance, it probably means that we're going to see more 50 basis point moves at times rather than the stock standard 25 basis point moves. But the simple reason is that if the RBA is meeting 11 times a year, it has lots of goes at it. But if it's only meeting 8 times a year, it arguably will have to move more quickly at times if it wants to get to a particular point in terms of interest rates. And we've seen that with other central banks around the world that have tended to move in bigger increments than the Reserve Bank does because they meet less frequently than the Reserve Bank currently does.
The board meeting will now be longer than is currently the case, from one morning, that Tuesday morning, to over 2 half days, and there'll be an internal pre-meeting. Why this change?
I think these changes are to give a better guidance, I guess, or more opportunities for the board to assess the recommendations that are coming from the Reserve Bank. So I guess it just gives more time for the board to assess things, leads to a better informed board, gives them more exposure to Reserve Bank research. So that should probably be a good thing.
There's often been a lot of talk about transparency at the Reserve Bank. One, yes, there'll now be a media conference after the announcement, but at the same time, the board hasn't decided to endorse, I guess, the publication of unattributed vote counts for now. It also says it's not doing that because it doesn't want to make a decision about another board, which I guess hasn't really been set up. Yet at the same time, though, these decisions about how frequent the Monetary Policy Board will meet has been made.
Look, there's some inconsistencies there because a lot of the announcements do relate to the new board that will be appointed to oversee the setting of monetary policy. On the other hand, there's some other aspects that have been left to that new board. Obviously, meeting frequency, you could argue, is an issue for the new board. So you could argue, yes, there's inconsistency there. But broadly speaking, this package of changes on its own does lead to more transparency from the Reserve Bank. Just having a press meeting 8 times a year immediately after every meeting does lead to a more transparent process. As an economist, I would say, well, I probably won't get that much more because the Reserve Bank governor invariably does a speech after the meetings anyway. But you'd have to say that the Reserve Bank will be releasing more here, more commentary coming directly from the Reserve Bank. You'll have the Reserve Bank governor, if not other spokespeople, explaining the decisions on the day. And also, in 4 of those meetings, 4 of the 8 meetings, we'll now get the long 70, 80-page monetary policy statement on the same day, at the same time. So there's going to be an avalanche of information within the space of an hour or two when the Reserve Bank makes those announcements.
It'll mean more work for professionals like you and I guess journalists as well at the same time. The other curious change, Shane, is the accompanying statement which comes with the decision will be attributed to the board as opposed to the governor, which it is at the moment. I mean, I guess part of that will be negated because the RBA governor will front the media an hour after that announcement will be published. But do you still think this is in relation to all the attention the current governor is getting, a lot of it bad around interest rates and the inference that the decision on interest rates is solely his decision?
Yeah, I think this is all about responding to recent criticism that maybe it's all at the hands of the governor. I think the Reserve Bank wants to spread that perception across the board as a whole, that the board as a whole is responsible, that they've had a good discussion about this, even though we don't know the votes. And rather than the current situation where the perception is that it's all the Reserve Bank governor. So to some degree, that makes sense to me.
Finally, and I know a lot of economists and professionals don't want to get into what will happen in terms of leadership at the Reserve Bank board in coming months, but do you think the RBA governor has done a good job, Philip Lowe, in his 7-year reign, given his job is up for renewal?
Look, on balance, I think Governor Lowe has done a very good job at the Reserve Bank. Yes, he made some mistakes through the pandemic, notably in relation to the guidance about leaving interest rates on hold out to 2024. But don't forget, they were extreme times, and I think if you assess the whole period, he's actually played a pivotal role in getting our unemployment rate down to a near 40-year low. And I think he should be given a lot of credit for that. He's also helped many Australians get through the pandemic without defaulting on their loans, given the easy monetary policy we saw through that period. And of course, like other central banks around the world, he's had to respond very quickly to this pickup in inflation we've seen. But of course, the Reserve Bank's in fact done it in a more balanced way than other central banks have. We've raised interest rates by less than other countries have. So you could argue that he's undertaken this monetary tightening in a more balanced fashion than other central banks. So my view is he has done a good job. Yes, he's made some mistakes like many others have, but I think he should be allowed to continue for another 3 years or so in this role, at least to get the job done in terms of getting inflation down.
Shane Oliver there, Chief Economist at AMP Capital.
Now, Market Day on the SBS On the Money podcast.
The Australian share market had a good day. The S&P ASX 200 up 0.4%, 7,135. For more, I spoke with Francesco De Stradis. He's an investment advisor at Ord Minnett. Francesco, the RBA governor announced changes to the way the RBA will conduct interest rate meetings from 2024, including frequency. So does this have any market implications at all?
Look, initial look at it, you probably think it doesn't, but when you sort of step back from it and say, well, 8 meetings a year compared to 11, I suppose there is potential there for some potential market impacts. With less frequency in meetings, it might mean sometimes that the central bank may need to make an adjustment greater than they would normally. So that would have a bigger impact upon the market. And I think the area where they're trying to be more transparent with their messaging would probably impact the markets probably on a positive way, because if they're more transparent and they're giving us more information, then our anticipation of what they might do would have less impact when they do make their changes on the market. And therefore, dealing rooms around the country won't be sitting there on the first Tuesday of every month waiting on the Reserve Bank to move on rates and create that volatility in the market. So I think it'll smooth it out a bit. They're really just emulating pretty much what's happening with the Fed and the UK central bank. I think the central bank here in Australia has done a pretty good job over the last 30 or 40 years to maintain inflation within their bands and a fairly steady economy. They did make a mistake, and the governor did mention that in his Q&A at the Economic Society lunch today, that the COVID period was unprecedented. So they'd expected that the world economy would have suffered a great deal more, and therefore they anticipated that rates would be lower for longer. That wasn't the case, and they have to react on what the economic conditions are putting forward rather than what might come forward.
Let's talk about the market today. It's up. Why, and what's leading it higher?
Yeah, look, the market's been driven by higher oil prices and higher iron ore prices overnight. So energy stocks are performing well. They're up about 2.2%. Resources stocks are higher, mainly the larger ones like your BHP, Rio, Fortescue, Min Resources. They're up. That sector's up about 2%. And on the flip side, healthcare's been under pressure of late, and I think that's a bit of a hangover from COVID as well. The healthcare stocks are off about 0.6%. Looking at areas of positivity, Incitec Pivot's up a bit over 5% today. There is some talk around them demerging the company into fertilisers and explosives. So Dyno Nobel may end up back on the market again. But they're also considering potentially selling the fertiliser business to a trade sale. So that's put a bit of a light under Incitec Pivot. It has been a very poor performer over the last 12 to 18 months as well. So it's interesting to see that going on. On the negative side of things, I mentioned the bigger resources stocks are performing well, but the small cap ones are under a bit of pressure at the moment. So I think a bit of money's moving more towards the large caps. They do look relatively cheap on an earnings basis, so I think there's a bit of money going that way. But all in all, positive day on the market so far. We did get a good lead from the US, and that was a result of those commodities prices, which I mentioned earlier as well.
Let's talk higher inflation and rates. They are hitting consumers, but how exactly is it being reflected on the share market, especially those consumer discretionary stocks? So note Kathmandu owner KMD confirming it is on track to deliver record sales, but at the same time, it's seeing a softer consumer sentiment.
Yeah, we've seen some of those announcements come out of the better retailers in recent times as well. So JB Hi-Fi was similar in their announcement probably a month or two ago, where they announced that they're on track to achieve their 2023 targets, but are experiencing a slowdown in sales. So I don't think whether you're a quality retailer or a poor retailer that you're going to escape the downturn in consumption. With the higher interest rates, higher energy costs, so higher living costs for households means that they're going to have to sort of forego some of this discretionary spending, and that's where some of these stocks fit into it. So, look, I'd be looking at exiting some of the discretionary retailers at this stage. I wouldn't be waiting until next year where we might see a real downturn in their earnings. And look, some of these stocks like JB Hi-Fi are good quality companies, but there's no need to be there at the moment. I think, we'll probably see in another 12 to 18 months a bit of a turn in the cycle, and it might be a time to get back into them.
Focus now turns to the US, the consumer price index out tonight. What's expected and what's it likely mean for interest rates? Because while inflation is still a problem in many parts of the world, not everyone is continuing to lift. The RBNZ left interest rates on hold today at 5.5%.
Yeah, so we're anticipating inflation to come in around 3.1% in the US tonight. So what's been happening over the last 12 to 18 months is some of those higher monthly numbers have been cycling out. So what we're starting to see is that trend coming off. So I'd anticipate numbers around 3%, 3.1, even 3.2. I think the Fed would be quite happy with numbers around those levels. If we start seeing 3.5 to 4, we could probably anticipate another rate rise in the US fairly shortly. On the New Zealand front, the official rates in New Zealand are already around 5.5%. So they're relatively high still compared to, say, the likes of Australia, for instance. And also that they've already dipped into recession. So we've seen their GDP start to decline. And then we've seen some storm damage over there as well. So So they've already dipped into recession. So I don't think the central bank over there needs to really tinker with the interest rates over there. They'll probably be wise to leave them as they are until they can see what happens with the economy over the next 6 to 12 months.
Finally, in this environment, are there any opportunities for investors at the moment?
Always opportunities in the market, doesn't matter where you are. Obviously leading into reporting season here in Australia, so it is a bit of a minefield. The risk is you pick up something that you think is good and they have a downgrade in their earnings expectations. We are moving into a confession season at the moment, and that's always going to put a spanner in the works. But look, I think I mentioned healthcare earlier. It's come off about 0.6%. It has been really one of the underperformers since the recovery after COVID. So I think there's some opportunities there in the healthcare sector. In financials, insurance stocks have been performing extremely well over the last 12 months. The likes of QBE, IAG, Suncorp. I think that might continue a little bit longer. So I think there's a little bit more in that trade, not too much more. So what's happened there is obviously you've come out the back end of a number of disasters with floods and fires and so on. So we're in a period now where insurance companies are increasing premiums, and then they've moved into a higher interest rate environment, which is all good for their investments as well. So the insurance stocks have been performing well. There might be a little bit more there, but going into reporting season and higher rates, I still be focused on the larger cap stocks and the smaller ones at the moment. I think we are getting close to that interest rate inflection point. When we do start to see interest rates come off, and that might be in the first half of next year, maybe second half, that's when I think the market will start to rally. But at the moment, I think we're just in a bit of a holding pattern, so we're range trading at the moment.
Francesco De Stradis there from Ord Minnett. This SBS On the Money stream is provided for informational purposes only. The content in this stream should not be understood as constituting advice or a recommendation. It is not personal advice and it does not consider your personal circumstances or objectives. You should contact a licensed professional before making any financial decision.